Welcome to this quarterly webcast, a short video interview offering you the chance to get acquainted with the views of some of our experts. Welcome, Carl.
Thank you.
I looked up this saying that says you must welcome change as a rule, but not as a ruler. A lot has happened this past quarter. What changes caught your attention?
Well, it definitely was a very volatile quarter. Volatile quarter dominated by yields and Greece. Government bond yields rose significantly worldwide. For instance, German bonds rose from 8 basis points to 100 basis points within 7 weeks. So very strong rise. And then we had the Greek saga, grabbing headlines almost every day, causing a lot of volatility. So in the end, over the quarter, global equities went down 3% in euro terms.
Let's go back to the Greek saga. Are your high dividend funds exposed to Greece?
Not directly. We don't have any direct investments in Greek stocks currently. We do have some exposure to European banks, so that might be impacted a bit. But they are better capitalized, and we expect that the ECB will support those banks if there's any funding issues.
I remember that market developments last quarter were a little bit on the downside, but are we back in the game? Because it looks like that.
I'm happy to tell you that we are.
Cool.
It was a very good second quarter after a difficult first. But all funds outperformed the second quarter compared to the broad benchmark. So year to date, most of the funds are now outperforming the broad benchmark as well. So a very strong quarter. There were no significant style trends in the quarter, so the stock picking worked well. In addition, I have to say that the rising bond yields triggered an underperformance of the bond proxies, the so-called bond proxies, like utilities and real estate, and low exposure to that category of the market helped the performance as well.
That calls for congratulations on the good performance, but will we be able to keep that up?
We believe we can. We remain confident in our current positioning. We are positioned for a reflation trade on the back of higher yields. That means that we prefer banks and other dividend growers compared to the more traditional defensive high dividend names. In other words, we believe that cyclical dividends will outperform the more bond proxies in a rising bond yield environment.
Well, let's see how that plays itself out over the summer. Thank you, Carl. If you would like to find out more about the strategy, visit us at nell'Azionario.com.